Good morning. My name is Maurice Crespi. I'm managing partner of Shareholder Attorneys. Shareholder Attorneys is a co-founder of COBRA. By now, I think we all know that COBRA is about providing pro bono services to businesses in distress. We do so via our knowledge base on our website. It's a fantastic portal, www.cobra.org.za. We do so by private Zoom sessions with you and your team. And we also do so by providing these daily webinars. So today we are joined by Dustin Graham and Carl Bates, who are dealing with the topic setting the benchmark when selling your business during COVID-19. And a bit about the panelists. Dustin, he's a M&A transaction advisor and managing partner of Benchmark International. He initiated a career in corporate finance and M&A advisory in 2006. Concluding various high-profile transactions before relocating to London, New York, and later Sydney, where he managed a diverse range of engagements in the forensic, fraud, and M&A space with leading international advisory firms. In 2009, he returned to South Africa to acquire a significant shareholding in a local industrial group of companies servicing the materials handling industry, and he spent 4 years in maturing the group and driving its organic and acquisition growth strategies. He has since sold the group, allowing him to return to the M&A environment, and has aligned with Benchmark International in their expansion into South Africa. Having been a key driver in the development of his own group of companies and heading Benchmark's national transaction teams, he is well positioned to advise both technically and through experience in all aspects of a corporate transaction. We're then joined by Carl Bates, who I'll be handing over to. He'll be hosting the discussion with Dustin. And a bit about Carl. He's a global entrepreneur, speaker, author, mentor, director, and dynamic thought leader. He's considered to be an international expert on business growth and the education and implementation of governance for SMEs and privately held companies. Carl is an experienced chairman and independent director with great insight into the operation of companies and how they can create long-term value for shareholders and other stakeholders, inspire their teams, and deliver effectively for clients. As founder and chief executive of Sirdar Global Group, he is world-renowned for his practical understanding of governance and is constantly invited to share his knowledge and insights on the subject. Carl has a Bachelor of Business Studies honors and a graduate diploma in Business Studies Finance. He is a chartered accountant and is a member of the Institute of Directors of both New Zealand and South Africa. So before I hand over to Carl, just to introduce the remaining panelists, we have Emma Marseille from IQ Business. As I mentioned, IQ Business is a co-founder of COBRA. Renee Klopper, also from IQ Business, and Gary Baruchowitz from Shareholder Attorneys. Carl, thanks so much. Once again, your insights are invaluable, and we welcome you back wholeheartedly. Thanks again.
Thanks so much, and welcome Dustin as well. If you want to unmute yourself and join us, that would be great. Really, for today, we're doing things a little differently for today's webinar. I'm really here in the role of interviewer, inquisitor, and it's great to be on the right side of that conversation. Of course, those of you who know me know I'm a Kiwi, and you can see the flag behind me. The closest Dustin ever got to New Zealand, by the sounds of it, was Sydney, and I think coming back to South Africa is at least a step in the right direction. But welcome, Dustin.
Thanks, Carl. Let me just correct you there. I'm an avid fan of New Zealand for some time, notwithstanding we'll get into some sport discussions no doubt later or after this. But no, I've been to New Zealand. I've actually done an Ironman race there before in Lake Taupo. So yeah, big fan of your country. Yeah, indeed.
Awesome. Well, look, when it comes to COVID-19, when it comes to selling businesses in this time around the world, what really gives you the authority to lead our webinar this morning and give us some insight into what people should be doing around selling their businesses at this time?
Thanks for the first question. Quite a difficult one. What gives me the authority? My goodness. So what I'm hoping to do today, Carl, is maybe just give a different perspective. I think I'm certainly not going to be technical in my answers. I think if you've got a fairly diverse audience, which I expect we have today, it would be somewhat untoward of me to give formal or technical advice. So I'm really just going to tell some stories and give a perspective from a seller's advisor's perspective. So certainly not going to promote Benchmark in this, but I do feel it's necessary for me to at least explain what Benchmark is and why, and why I can talk around this. So Benchmark is a sell-side advisory M&A firm, which serves the mid-market. So what that means, it's a lot of words, but what it means is sell-side advisory, we do not take any mandates from buyers or investors or the like, okay? We simply serve clients, entrepreneurs, founders, business owners that are looking to either exit their business or inject growth or strategic capital into it, okay? Why I regard myself as somewhat of an authority, well, I don't, but I think that I have some perspective on it. We've got a fairly wide spectrum of clients, and I think we're a fairly good barometer of what's going on in the country. We see businesses across sectors. We see various different size businesses and various different growth phases with different attributes to them, and we understand what they're looking for, and we go out to market and invite comments on those businesses looking for investors. So a lot of conversations are being had, and we have it without having our own balance sheets. And what that means is Benchmark don't actually partake in any investment or buy out any businesses ourselves. We're a purely advisory firm. So we have quite authentic conversations with clients in this regard.
And so with that sort of insight into what's going on in South Africa at the moment, where is M&A at the moment in South Africa trending, looking? What's going on from what you've seen as a result of COVID-19?
Yeah, okay, good question. So look, immediately, I get asked this question daily. A lot of my clients or prospective clients are nervous. They immediately would consider that there might not be any buyers out there. Investors have put the brakes on the country. But I just want to take a step back for a second. I think it was, if we dial back like 18 months, we were in South Africa now, we were in a situation where we had elections coming up. We had a very enthusiastic round of load shedding that was going on. And we had a downgrade looming. And it was like a trifecta, like a perfect storm that happened. And at that point in time, I was quite concerned about how the world looked at South Africa and whether or not there was some pause in potentially taking the leap into South Africa, certainly looking at the international parties coming in. But there wasn't, all right? There was still investment happening through this.
Yeah.
Now, if we just go forward now and then look at what COVID is not a South African problem, in my view anyway. It's a global problem, all right? So this is a risk that is pervasive and inherent across the world, all right? So with that in mind, let's park that for a second and let's go and answer your question now. What is M&A and how does it actually work? I've had my own business before, and I know that in trying to sell that business, there was a little bit of fear going on. You have this, will anyone like me? And will anyone want to buy this business? Who wants it in particular now? Mergers and acquisitions is such an inherent function in any major corporate or financial office. You can't switch it off. They've all got strategies around M&A. So I'm not going to pick on corporates at the moment. I'm certainly not going to do that. But I think we can agree that for the large part, corporates are, or bigger businesses, certainly a little slower moving, all things equal, than smaller or mid-market businesses can be, all right? Smaller and mid-market businesses are innovative, or they can be more innovative. They can have great talent around them. They can be quite adaptive in these situations. And what we are seeing is that bigger business or corporates or financial offices have to deploy their cash resources in any event. It's got to happen. They cannot sit on cash resource. They are not earning the right returns for their investor base. So they've got to kind of put it out. That's the one angle. It's just the deployment of cash and getting a sort of return. But let's go to South Africa. The mid-market, and I just want to qualify what that means. So, well, what we believe it means anyway. Mid-market we regard as businesses that sort of fit in the 50 to 500 million rand enterprise value. In that band, it's got a different interpretation in the States. Certainly, you can just add a zero.
Yeah, exactly.
Yeah, but just talking here. So what we find in that size business is that you've got some of South Africa's super talent. entrepreneurs that are having to overcome obstacles that this country presents. They're very adaptive, they're very maneuverable, they're very innovative, they're good coaches. And quite honestly, they've had to overcome quite a difficult business trading environment, right? So coming in as a corporate, you know, and we've done a few transactions like this where they look and they say, look, that's a great vertical to get into, or we want to diversify into a certain sector. Let's go and rather buy than start. Because in buying or in investing, we get that business, it's got legs, they've overcome the obstacles, we get the talent, we get the teams, we get the culture, and we bring it in. So M&A is here, it's here to stay. In fact, it likes volatility. You know, when we see an economy all over the place, that's where we see deals start happening. But I don't want to say, look, I mean, it doesn't mean that there hasn't been an impact on values and structures and things. It just, to answer your direct question, M&A activity is still prevalent.
So we've seen internationally a number of big ticket deals being scuttled as a result of COVID-19. People using COVID-19 as a reason to get out of buy and sell purchase agreements for businesses. Are you seeing that here in South Africa?
Okay, so a reason to get out of gives me an immediate pause. Why are they looking to get out of it? So I don't understand that, because if the transaction was authentic and for the right reasons in the first instance, COVID wouldn't change that. If it was quite parasitic, or if it was quite opportunistic, then potentially I can see that happening. Okay. Yes, I've seen some deals stall, very definitely, and it's quite deal dependent. Let me give you two examples. I think I've had two deals that have pushed pause at the moment because of COVID, but they were very heavily reliant on bank funding. What that kind of means is that you've got a buyer, seller, and you've got a bank who's an inherent third party to that transaction. If the bank doesn't have the same risk appetite necessarily as that buyer did, then that leg falls away and that transaction would have had to stall. Similarly, though, we've seen transactions accelerate. So yes, it's a little difficult to answer in isolation.
So if we come to that sort of seller side, and you know, I think a lot of the guys and girls joining the call today are looking at it from that perspective. If you were pre-COVID thinking about selling, and I think we can talk about businesses that are selling as a result of COVID as sort of a separate point. But if you're talking about businesses that pre-COVID were in the process of selling, and their industry may have been affected or may not have, and you might want to speak about those two things differently. Yeah. What's some sort of initial high-level advice you've got to people who were thinking about selling pre-COVID and are going, well, am I still going to get the same value? Is it still as easy, etc.? And maybe we can speak about those that are affected by COVID and want to sell as a second question in a moment.
Yeah. All right. So let me just make sure I understand. So we're looking at businesses that were thinking of selling pre-COVID. Short question is really, should they continue? What should they be considering? Right, is the first part. Okay. So again, we come across this all too often. And it's not COVID. So I want to make it something that we can all look to and understand and have experience around, and then we can bring that forward and we can talk around COVID. There is in business, in the mid-market, there is every single opportunity to stall, to hold, to pause if you want to find it. All right. Clients or potential clients will come to me and they'll want to sell their business, but they will want to get a new BE verification done first, or they will want for their financial year to end first, or they will want to land a particular contract first, or they will just want to clean up some of their sort of divisions that they don't think are profitable anymore. Whatever the case is, they find reasons to maybe stall the process. COVID, it's just a really big reason around that. Okay, if that business was still had like the good foundation, if it had all the good attributes that it could have or should have had, I don't see any reason for stalling. It's just going to be another reason to pause. Remember that a company's reason, or a seller's reason for selling, is not a buyer's reason to buy. Okay, I'm just going to let that sink in for a minute. If I've got a business and I want to sell it because I am of retirement age, or because I need to de-risk, or I want to inject some capital into my business and I think this is the best way to do it, those three reasons don't hold any water to why a buyer wants to come in necessarily. So in making the decision that you want to pull your business off market in this period, what you've essentially done is you've gone out, you've forecast what those buyers are thinking, and you've probably done it wrong, because a buyer wants to come into a particular business or a sector for its own reasons. It might want to diversify or grow, whether that's products or services or territories or people. And by taking it off, you lose that chance. And yeah, I'll talk about it later if a good question comes up around it. But it's all about timing. We don't, at least because I would get bored otherwise, we don't operate in a vanilla space. You know, it's not about here's company A that produces widgets and here's company B that needs to produce widgets. Surely there would be a match. It's only a match if company B is looking at that particular moment in time with the cash resource available and whatever, and the appetite to acquire company A. So timing is such a critical thing. To pull your business off market during this time might be to your detriment.
You know, I think you're hitting the context for people that are thinking about, well, what should I be doing in this time? And I know we've already got a question come through around value, and I'll ask that in a moment before we go to affected by COVID-19. Just a comment for everyone. If you've got a question, if you want to ask something on anything Dustin's speaking about as we go through the webinar, please feel free to throw it in the chat box and I'll find the right moment to bring it into the conversation. So for those that are going, okay, well, there's 100 reasons why I might pull it off the market. I'll leave it on the market now. How significantly are you seeing COVID-19 impact valuation, either for the positive or for the negative? And I'm not talking about the obvious. Like, you know, if you're in the restaurant trade right now, there's a significant impact to your valuation and that you can't get away from. But as a more generalization, what are you seeing as the impact on value in the last month or two?
Yeah, good question. So I'm going to be conflicting in my answer, and I'm going to tell you that immediately you were wrong in drawing reference to the restaurant trade. You know, so let me give you a story. I have had a particular hospitality tourism asset, quite a significant one, on market for about 24 months now. And it's been attracting very little interest until COVID hit. And COVID came about, hospitality tourism, hey, this is interesting, is shut down, all right? And now it's got local and international parties hammering it, right? Desperately keen to get into the space. I can't understand that, all right? But it definitely talks to my point that be on market, be available for the investor base to come in and ask the right questions. So look, generally that's a little unusual, but yeah, some sectors are being affected a little bit more than others, but let me just try and talk in general. Value is being impacted. It's being impacted on the positive and negative end. I'm very glad you didn't ask me about multiples, because I would have very quickly shot you down and spoken away from multiples. I don't believe in them inherently, but value, what COVID is, it's like an exposure. It's kind of as though the mist has been lifted, all right? And a lot of the gray that was around M&A previously is gone. It's cutthroat, it's very clear. Okay, so it's like an elastic band. So a good business, all right, is attracting awesome interest, a lot of value, and people are coming in for first mover advantage, all these new and exciting reasons to transact. It's simple economics, right? In that environment, when you have a particularly good asset and lots of observers or interested parties to that asset, the price is naturally going to go up, right? And value and deal values are going to naturally go up. On the other end of the elastic band, unfortunately, we might have a business that hasn't been too innovative in the last years, has some sort of old models around it, and sunset kind of models. Yeah, that's going to get impacted negatively on value, because an acquirer might look at that and measure that business against their next best alternative, which is to start that business themselves. Let me give an example. Forgive me if anyone in the audience has a battery business, but those of you who know me, I pick on this particular example every single time. If we've got a battery business and a particular acquirer is looking at ABC batteries and they think, no, this is what I need to get into. If normally there are two battery businesses on market that fit the criteria, that particular acquirer is going to be measuring those two up versus starting it themselves. What we're seeing with COVID now is that there might be 8 or 10 battery businesses on market, okay? And that particular acquirer has now a suite of 10 different options to it. The other end of the economic spectrum, more sellers in that instance, in that particular sector, lower pricing, all right? Unless that particular business had something to it that buyer sought.
So one of the things we're seeing during this time, and we've seen through some of the work that we do on our side at the Sirdar Group, is businesses thinking about how to merge in order to make themselves more palatable to an exit or to a potential acquisition, or to find a way of surviving as a result of the fundamentals that have changed in their industry. And there's a couple of different examples that I've been looking at, or we've been working with in terms of clients around that. Have you been seeing some of that sort of thing where people are not necessarily wanting to sell just to sell out, but are coming to you to engage in conversations around how can they restructure, reset, reframe, reimagine their business for the future?
Yeah, that is a really good observation. So, I'm being so kind to you, Carl. You're asking such good questions.
Very much.
Yeah, we call it a consolidation of survival, and it's more prevalent now than we've ever seen before. So you've heard of verticals before, potentially.
Yeah.
Essentially, what a vertical is if a particular group, whether that's a corporate or a financial office, are looking to create a link up to a whole supply chain. Okay. We're seeing a lot of it now. In fact, we're dealing with 2 at the moment. It's very good in a volatile environment where company A and company B could be really good together. They could rationalize costs. They could enact some of those synergies. They get rid of some of the old headspace that would have prohibited a deal, which could have been ego or pride or, the fact that they were competitors. Because what they do now is they've got a third party, which is potentially a funder, coming in going, guys, I need to deploy capital. And you get this perfect marriage of businesses that 3 of them together, whether it's a funder and 2 businesses or 3 businesses that come in together, are much better off than they would have been in isolation. Again, it just talks to teams that are open to be flexible, that are looking at changing up their business model to adapt to these times. And I think that's, if I can summarize today's theme, it would be that. If businesses are out there and they are flexible, if they can get rid of what they believe M&A is about or how it works, and just think about today, what does this environment present for me today? Get rid of that thinking, be flexible. You're going to have a successful transaction if that's what you're looking for.
And are you the sort of person or that someone should be having that conversation with if they've got a business where that as part of a journey, if you like, of trying to understand what the options are for them, what might happen in their industry, could happen? Is it too early for them to have a conversation with someone like yourself?
No, it's not. I think I'm always happy to have coffee chats. And the bottom line is, I subscribe to your business always being on markets. I just want to push pause here for a second and try and explain this, because it's also a super important point. You should always be selling your business, always, right? But your buyer changes. What that means is that you should always be buying your business back from yourself every single month that you're in business. All right, and sort of making decisions along those lines. Your business will come across this often, Carl, where a particular founder, let's go to a smaller business in the mid-market space that doesn't necessarily have all the right governance structures or executive structures around. A particular founder or owner might be an employee, a manager, a director, and a shareholder, all wrapped up in one.
Yes.
And in COVID times, gosh, they're probably also the admin person and the receptionist and the HR person and the accountant. So I'm going to get confused, right? And my experience of this is that the shareholder hat that they wear is too often the one that they discard first. And they go, look, I've just got to deal with the fire right in front of me. I've got to answer these calls. I've got to keep my customers. I've got to do whatever it is. But they don't think like shareholders. So I would encourage owners to take a pause once a month, once a quarter, whatever it is. Put that shareholder hat back on. Buy your business back from yourself. Say to yourself, I believe my business is worth 50 million rand. All right. If I had that amount of money unencumbered in a bank account, okay, would I swap that amount of money out for my business in its current form? 9 times out of 10, the answer is no. When you ask them why they've said no to that, they will say, I'll get rid of this particular division or that particular staff member, or I'd start doing this, or whatever the case is. They come up with a list of 10 reasons that what they would do were they to buy their business back from themselves, and it always intrigues me as to why they're not doing it at the moment.
And I love that framing. I actually call it the law of shareholder wealth creation. And if you don't treat your business as an investment, you're never going to be successful. So
Right.
same page. I'm sure everyone is listening in and going, okay, but what about my business? And if you've got a question, as I say, please do throw it in the box so that we can bring it into the conversation. So tell us, what sectors are you seeing particular interest in South Africa at the moment? And what sectors do you think, if people are in, they should be really having this conversation?
Yeah, okay. An unfair question because, I'm going to answer you according to what you can just Google and read, okay? And just what logic presents anyway. The usual suspects, right? Okay, so if we've got e-commerce kind of businesses, tech, data-driven, they are very definitely the flavor of the month. They're the flavor of the month, or any knowledge-based business, right? They are super attractive at the moment, just by virtue of the fact that that's where the world is moving. And we've got all these new investors and acquirers looking at that to get a first mover kind of advantage. But that's going to dishearten a lot of today's audience, okay, that aren't in those sectors. So I want to answer that a little differently. Every single business, go back to my hospitality example, every single business can do well in today's environment if they have some of the sort of core principles at hand, which is get your governance structures right. If you are cash generative, if you are solvent and liquid, and I can come back to that one, then you are going to be an attractive business. We find some fairly sizable businesses out there, billion rand turnover businesses, that within 6 weeks of COVID hitting have a liquidity problem, have a liquidity crisis, okay, and are looking to actually acquire or invest in other businesses to gain some liquidity. So if you have a fairly strong balance sheet, and it's interesting, like I'm an old school accountant. I still trained in the 1973 Companies Act in the good old days, and we were and we were taught all about balance sheets, all about balance sheet, be prudent, that sort of thing. Along came all of these revenue multiples and things like that, and all these intangibles that I still don't quite know how to quantify or measure. But today's environment is giving me a little bit of comfort that some of those old tested methodologies of apply the solvency ratios, stay liquid, and be able to weather a storm is definitely it's given me a lot of comfort.
Now, you mentioned it, so I have to ask, and I know that we want to spend a little bit of time on how you should be preparing yourself for sale. If someone's in a space of going, hey, this is a way I want to get out of it. And I want to talk about preparing for sale for those that are in a good space, and I want to talk about preparing for sale for those that aren't in a good space, and maybe just seeing this as like, I need to pack up shop and get out of this, and selling it even for rand might be better than what the future holds. So we'll talk about those two in those two sort of categories. But you mentioned governance and its impact on business value as part of preparing, and given obviously that's my space, love to have a few words from you on your view on the role of governance in multiples and business sale, etc.
Yeah. Okay. So, which question do you want me to go with first? The preparation thing,
and then we'll come back to the sort of preparation.
Okay. So, look, when I can deliver an 8-hour sort of seminar on preparing your business for sale, and I normally go into the fact that you've got to get your cornerstones right, which is your financials and governance structures. I'm dealing with a situation at the moment, and I like to answer through stories or analogies rather, and you can draw your own inference from that. So I'm dealing with a really good business in the chemical sector that has it has a shareholding complement that also serve as the directors, so the two shareholders, consequently 2 directors, and they have a shareholders agreement that is some 20 years old. It doesn't make provision for today's environment at all, and they are in a process whereby they want to potentially sell, but that structure in isolation is completely prohibiting the process. So it's really difficult. If your shareholders agreements and the other governing documentation that services your business is not up to date, and if it's not relevant for that particular year, because people's ambitions change, their needs change, shareholders differ. And if your documentation doesn't keep up with that, and if you don't have a sort of reporting structure that allows for it, you're going to get yourself into a muddle when later on when you're trying to offload this business for value. and people have different mindset to it. So yeah, I think your industry is super relevant, Carl.
Thanks. Good to know.
Yeah,
good to know we've got a business we might be able to sell. Tell me, what are some of the things you think that those on the call, other than governance, that are thinking about preparing their business for sale or wanting to do that and are in a good space? And we'll talk about those in a moment. What are some of the other things they should be doing to prepare their business for sale, given the environment now?
All right, I'm going to actually answer your questions for those that are in a good space and a bad space. Okay, I'll be a little different about them. Let's talk about some of the things people should be doing that are across the board, whether they're good or bad space. I'm not, as I said before, this is a long conversation, but I'm not going to go into your financials, your governance, and things like that. But I'll give you maybe, I'll give you maybe two answers that might resonate. Remember my previous story about buying your business back from yourself. All right.
Yep.
So each business is a little different. Do that. I would encourage people just to take pause, open up a blank piece of paper, buy their business, and tell themselves quite authentically what is currently wrong with their business. Step into the headspace of the buyer. All right. So a common mistake people make is they believe they have to polish up their business before going to market, and it's just, I don't want you to have cancer in your business, okay? I want you to have warts in your business, not cancer certainly, but buyers expect warts. They expect there to be some headaches with it. They expect there to be some inefficiencies and things that they can potentially change. If you're in the headspace of a buyer and you can present your business warts and all and say, look, I can fit into your business, into your organization this way. That buyer might look at it and say, we would change A, B, C, and D about it, and therefore we'd be able to extract some synergies immediately. Don't polish it up, okay? So don't do those sort of things. Focus on the little black box that is your business. So I always try and encourage clients of mine to find what that black box is. It's not a pure financial game, this, all right? You might have a particularly hot sales team, or you might have an awesome organization culture. You might pay a lot of attention to employee well-being, or you might have awesome talents in your business. So I would focus on that, because certainly some of the bigger buyers out there, they might need that injection into their group. And I guess keep your forecasts really up to date, what your business is doing, because if you can demonstrate to the market that maybe you are being quite negatively impacted now in this moment, like most are, it's quite understood. I would rather you demonstrate what you're doing to address that, what your plan is, how you've addressed your business model, how you've asked some tough questions of yourself, how you are not precious about retaining some old methodologies and you rather just rethink things. Don't throw good money after bad kind of thing. And I think if you go to market on that basis, observers to it are going to be quite enthusiastic around it. Yeah. So, yeah.
Awesome. And for those that are in a position where they're not necessarily selling their business because they wanted to, or it's a retirement exit, or this was the year that they planned to, or whatever, but have found themselves in positions where they fundamentally see the outlook for their business isn't what it used to be, or because of family, they've all of a sudden got to relocate or move because of the way COVID's changed the world. What do you say to those individuals around what they need to do to get the best value while recognizing that value might not be the driver for why they need to get out now?
Okay, yeah, good question. So be flexible. I'm going to just answer it in one way and just say be flexible today. The reason I say that is, let me take, I'm going to pick on private equity. So I apologize if anyone on the call comes from that space, but I'm actually going to do them a favor here. Private equity, in general, a lot of conversations we're having with them at the moment suggest that they are being quite innovative in the way they do things, right? So 6 months ago, where a sale might have been the only option available, now we're seeing a whole lot of different mechanisms and instruments come to the fore. All right. So if a seller finds themselves in a situation where they're between a rock and a hard place, they believe that sale is their only alternative to address whatever that risk is that you're suggesting, I would discourage that. I would say that there is money, whether it's a recapitalization, whether there's a particular placeholder shareholder that could be put in place, whether it's a leveraged buyout, I don't know, whatever it is. But there are so many different options today available because buyers and sellers alike, if they're flexible, deal making it's like deal making utopia out there at the moment. Yeah, hey, it's like the first time us accountants have ever got a chance to be creative. It's really our time to shine. You know, we've never really been creative before. We've never been allowed to. So I'm quite encouraged by it. We'll probably see a movie come out about accountants after this, because I think there's only been one movie ever written about or made about accountants, and it was that Ben Affleck one, and it was actually called The Accountant, wasn't it?
Yeah.
And then he ended up being a crook. So it was. So I'm hoping that this can change. The bottom line is that be creative, be flexible, have the conversations. There are a lot. Money's got to flow. All right, it's got to happen. So just avail yourself to that, and don't be precious about, I must sell all of my business or nothing. I'm not going to earn out. I'm not going to stay behind. I want a certain multiple because my mate at the country club told me that's what multiples you get for businesses. Get rid of all that, all right? And just be available to have conversations. The solution will emerge.
You know, in terms of timing and process, and I think, you know, this is probably one of those questions that the answer is it's a piece of string as well, because things are so different right now in the market. But generally, what is the time frame? If someone's going, this is something that I need to do or I want to pick up on, what are the sort of time frames people you think should expect?
Yeah. Okay, so it all depends how you. I presume you're talking about a sale here. So, if we're looking to sell our business, and we actually want to go through a process typically suggests that we're going to get some information ready for it. We're going to go and target a fairly wide audience to look at our business, and then we're going to go through a due diligence legal phase. That takes anywhere between 9 and 18 months if it's well run. All right. But that might sound, you know, quite quick and awesome if you've booked your flight to Sydney and you want to get out of here, and you think, oh, cool, Dustin says it's only 18 months and I'm tickets. It's not. So if you want to get actual value for your business, you've got to be prepared to hang around for what we're seeing anyway between 24 and 48 months after transaction to handover. So that kind of means you're looking at anything up to 5 years to get full value for your business. That said, some businesses at the moment are transacting within 4 months. It all depends. So to your point about it being a piece of string, I would just encourage people to take a longer term view in it. And if you can just have in the back of your mind, this is going to take me between 3 to 5 years to extract value from the time I push go. That's about right.
So again, just a shout out for any questions. If you want to ask a question privately, you can just put it to the panelists. And I'll ask the question, and I won't name who's asking. If you're happy to indicate who you are, then feel free to put that in the question, and we'll use that as well. There's one question that's come through, and it was that strong company performance to date will not command the same selling price pre the COVID-19 impact. So that sounds a little bit more like a statement than it is a question, but interested in your view for the individual on the strong company performance to date will not command the same selling price pre the COVID-19 impact.
Yeah. Okay. Look, I think let's go back to COVID being a global problem, not a South African one. So all businesses are in this together, right? So I think if you get an opportunistic buying environment, yeah, you might find that certain buyers are taking advantage of the fact that a particular business is underperforming relative to what it could have performed or what it's historically performed against, and they might be pricing it accordingly. But we're not selling properties here. We're not selling houses. You know, a business is unique, and if, like anything, if you take that particular business to a range of potential acquirers and you create your own sort of mini competitive environment, different buyers will have different reasons for looking at that potential business. Some of them might be financially orientated. Some of them might not be. Some of them might be looking at solutions and the people in that business. And with sort of careful structuring, you can retain that value. So yes, the cold answer is that it might impact value if it's not carefully structured. But let's find that little black box that I spoke of earlier. Let's go to a range of potential acquirers. Let's not be precious around our structure. Let's make sure that we demonstrate what the inherent value is of our business, what it did. Let's demonstrate how we are malleable, how we are innovative, how we're challenging our own business model at the moment, how we're getting through this. Because the number one reason to uplift your own value in a business, in a transaction, is by not being desperate about it, and by demonstrating to the acquirer that you've got an alternative, right? And the alternative is to hold your business yourself, to buy it back from yourself and to hold it, because you demonstrate a certain value to that.
I suppose we could take a point from rugby on that. The All Blacks, we never worried until the 83rd minute,
No, that's right.
If you hold out, you can still get the try.
Exactly.
With value in mind, there's a question coming through. What is the easiest way to evaluate or value your business?
The easiest way to value your business?
Yeah.
Okay, so I'd like you to, I'd like that the person that asked that question, they can go and Google all of the different valuation methods. I'm not going to go into that. I'm not going to be technical here. So I'm going to rather use a trick. The first trick is I'm going to ask two questions of that person, okay, and they can answer it in their own time. The first one is one I've alluded to earlier. What is that number that you would place in your bank account unencumbered, right? So we're taking a circa 50 million rand business, yeah? You have 50 million rand sitting in a bank account, no conditions to it, or you have your business. Which one would you choose? Keep asking yourself that question, right? Until you get to the number where you actually choose your business. It's at that pivot that's what your business value is, all right? Because it correctly demonstrates the exact point where your next best alternative is against the sale, all right? Number one. Number two, imagine that you have, let's go back to our 50 million rand business. Let me present you an offer for 50 million rand for your business, and I need a person to sort of think around this. Let me present you an offer for a 50 million rand business, and you get this offer, you've got it in your hands, and you're reading it, and you go, I don't think it's quite enough. I'd like more for my business. I think it's worth more, all right? How would you feel if I took that offer away from you? Would you feel relieved that I've taken that offer off the table, or would you feel quite disheartened that I've taken that offer off the table? So it's a negative assertion. If you feel disheartened that I've taken that offer away, it means that value is probably getting close to what it should be. All right. So go to your accountants, let them do the technical valuations, the discounted cash flows, all those different nice fancy things. Sit down with it. But my experience is that entrepreneurs in the mid-market space, you ask them what the value of their business is, they're going to tell you. And they're going to say, my business is worth 80 bar. How did you get to that? I don't know. That's what I feel it's worth. And 9 times out of 10, they're right. There's no science to it. It's a feeling. And the feeling comes from those 2 suggestions I had before. They're just doing it without themselves even knowing it.
So a couple of questions leading on from that, maybe to start bringing us to a wrap up and obviously opportunity for a bit more of a Q&A if there are other questions that come through. But you alluded before to recapitalization. So 2 questions related to that. What alternatives do you see to selling your business right now for those that need those alternatives? And what role do the likes of yourselves play in supporting that process?
Okay, so look, again, I'm not going to promote Benchmark too much in this, but any corporate advisor, I would suggest corporate advisors that don't themselves present balance sheets. What I mean by this is if you go to an advisory that has, or a firm that has an advisory angle to it and a balance sheet, you might not get the most authentic answer, right? Because balance sheet always beats advisory. But if you go to an advisor and you say, look, what is available for me? Let's have a look at that balance sheet. Remember that money has to flow. So we're seeing a lot of financial offices, whether that's private equity, VC, family offices in general, any financial institution or financial buyer, we're seeing them be quite innovative in the way they're deploying that cash. All right, so there are a lot of instruments available. I can't get into that now, but if your balance sheet just needs cash, it's available. It might be through a fairly innovative instrument, but it's available. I just think that it's difficult for me to answer that without actually seeing the balance sheet in front of me. Yeah. But buyers or investors are very comfortable in today's environment with putting money into a business. They've got some hesitation about money flowing out of a business. So a sale is a lot more difficult to sort of negotiate at the moment than a capital raise, as an example, because of people have to do something with their money. If they can invest it into the business for growth and for just fixing up and getting the ratios right, that's a lot easier conversation. It moves a lot quicker as well.
Awesome. And what have some of the businesses you've come across during the last couple of months been doing well? So for those that are wanting to test if their strategy's right, if the approach that they're taking is right, what are the things that you're seeing businesses do that you consider that they're doing well or have been doing well, during the last couple of months?
All right. I would say businesses that aren't precious, they're not throwing good money after bad or good energy after bad. They are mature enough to look at their own businesses, their own models, and take a step back, maybe just evaluate, to my point earlier, what hat they're wearing, look at it from a shareholder perspective, and just re-evaluate that business, buy it back from themselves. If they take off their blinkers, by doing so, the product of that is that they're going to understand their alternatives better. Their alternative could be a recapitalization. It could be a sale. It could be hanging on to the business in its current form. It could be completely revolutionizing their business model. Whatever that is, if they get their alternatives in front of them and they can sort of value those alternatives, we find that those individuals and those businesses are faring a lot better. So it's just the ones that are up to date. If we find businesses with old documentation or old models or old processes, and they're trying to just hammer those and keep those going through this time, it's like trying to put a square pin in a round hole. Is it a square pin in a round hole or a round pin in a square hole? I've never quite understood that one. But
or a peg.
Peg. So you get my point. If you're trying to do the same things as you've always done in today's environment, it's not going to work.
Yeah, I think we're seeing a lot of that as well. And certainly when we've been involved in a couple of projects through this time, one of the things that we found quite interesting is having that dynamic of different people not from your industry. And anyone on this call thinking about selling or going out and considering recapitalizing or whatever the outcome is, I think getting that external perspective is really important right now, because it's often from that where you get that insight or that value. So I want to shout out to the audience and to the attendees and just say, are there any sort of questions you want to ask at this point? This really is your opportunity to challenge Dustin, given some good questions to answer. I've done my best at trying to throw him some curveballs in this process, but it would be great to see if there's any other questions from the audience or from the other panelists at this point. Dustin, maybe while we're doing a final call for questions from the audience there and from the other panelists, from yourself, if you were to say, look, these are the three most important things that people need to do in considering to sell their business from this point forward, and obviously you've alluded to them, a couple of them. I love that one about thinking about selling your own business. What would you pay for it? And the other phrase that I took earlier from today is always be on the market. I love that. There's actually one question here that's come through before I get you to answer that. It's what are buyers doing differently to guard against perceived COVID risks in transactions? I really like that. What are buyers doing differently to guard against perceived COVID risks in transactions right now?
Good question. So I'm going to answer that by telling you about a transaction that really went wrong, because I like talking about the things that went wrong. We transacted a business in December last year with a 2-year earnout to it, or contingent element to the purchase price payment that has just been nuked. So this business, I feel so saddened by this, but essentially they had to take like 4 to 6 months, or they looked to take 4 to 6 months out of this financial year. It's just going to absolutely hammer their performance. That's not going to hit the targets. They're not going to get their earnout payment. Because when we structured that deal, there was no such thing as COVID. We didn't understand that something could be this material or big. What we're seeing come through in today's structuring and in today's legal agreements is an addressing of that risk. All right, so we're not prepared to make this mistake again. If there is something, I don't want to call it force majeure because I've got some attorneys around and they're going to shout at me if I use all of these like fancy Latin terms. But look, certainly in today's structuring, from the buyer and seller perspective, we're seeing it come into the legal agreements in some form. And the reason for that is if a transaction is authentic, a buyer is not trying to get a particular asset for the lowest price possible. That's a misconception. What they're trying to do is they're trying to buy that asset to serve the purpose for which they looked at it in the first case. That could be amazing management. That could be innovation, whatever it is. If they underpay on that asset later on, they're not going to have that sort of incentivized management going forward, and they could potentially lose that particular asset they bought for whatever that reason was. So it's from both perspectives that people are looking to protect against this. So we're seeing these conversations happen more frequently.
Awesome. There was one other question that came through, but I've just gone back to ask a clarifying question. So if you were one of the individuals who put a question in the Q&A, there was a clarifying question I went back to on. There's another question that's come in. What is the best way to get the word out that your business is for sale, but keep it confidential?
No, good. No, but you laugh. It's a brilliant question actually, because it's a fantastic question. It's one of the major obstacles we certainly have that our clients present to us almost every single time. No one wants to have the appearance of being on market and being desperate or whatever that might be, whether their competitors, their staff, their supply chain get wind of this. It could have negative business impact, right? So it's a great question. I think what you've got to do is go through a process. A process does not take your business and put it on some sort of platform on the internet and say, hey guys, I'm for sale. That's not the case. Going through a process is quite specific. You target 40 to 80 potential acquirers only. These are acquirers that are, they're sophisticated. They do this all the time. They understand not only the words in an NDA, they understand that they cannot go and sort of on market this particular opportunity. But if you go to market with a narrative of, I'm looking for a growth or strategic partner into this business, it might end up being a complete exit. But if you go to market saying, guys, we're doing well, these are our forecasts, we need some recapitalization in this, we want to find a partner to help us launch off this platform, then even if that opportunity falls into the hands of your competitors or your supply chain or your staff, it's still going to have a really good positive message that goes around it. So we certainly try and encourage that when we take businesses to market, because you can, while everything is done to keep it confidential, an NDA sometimes is not adhered to by some of the less ethical outfits out there. So we have to make sure that the underlying message is still one that isn't going to compromise the business.
Great, thanks. That's awesome context. Okay, I think let's go to that sort of final question on the 3 points, and then we'll wrap it up from there. All right. The clarifications come through. Sorry, Dustin.
Yep, no worries.
From an owner's point of view, which is medium term more sexy at this point in our economy for a buyer and for a seller? So the initial question was cash or profit, and then the clarification is from an owner's point of view, which is medium term more sexy at this point in our economy for a seller and for a buyer, cash or profit?
Depends on your industry. So a loss-making business in e-commerce that demonstrates its ability to grab market share despite its profitability or its cash generation is super sexy at the moment, okay? If we've got a sunset kind of business, by that I mean, let's take a manufacturer of an older technology or a product that could be subject to, redundancy. If it's cash generative, it can be used as a cornerstone in a vertical. In other words, it can help finance a particular deal. So in that instance, cash is like amazing. Profitability, when we're talking about structured deals with corporates and the like, when profitability comes in, I'm going to use the word multiples, and I promised myself I wouldn't do that. But if a business is transacted at a multiple of 6, 7, or whatever the case is on any base that we choose, and a particular acquirer is operating at a multiple of 15, 20, profit is more important, because it's just a financial engineering process where they can, they can enhance value just like that. That's the new accountants that know how to do that, not me. So it is very dependent. One answer, though, I would say, if I had to choose an answer, it would be cash, because liquidity is a new problem that we're facing, and it's more prevalent than it's ever been before. So if your business has the ability to generate cash, and if you have sufficient liquidity, you find that you are being well courted by the market.
Awesome, thank you. So let's do that final question then. Those are 3 key points.
Okay, I've been thinking about this in the background since you asked it. So if I were to say 3 things from today, always buy your business back from yourself. Ask yourself those tough questions, right? When those and they're specific to your business. When you ask those tough questions of yourself, you'll be able to see, in my view anyway, what another buyer would see. So buy your business back from yourself. I would encourage the audience to remember that your reason for a sale is not a buyer's reason to buy. So you might have a bit of fear about things. You might look at your business and see all of the problems with it. But if you can just find that one little piece of magic in your business and something you're really proud of, and promote that, you will find buyers that are looking for exactly that. And it could just be yourself. It could be you, the entrepreneur. And then I think the final thing would be flexible. Unlearn everything you think you know about M&A in general. Take all the books, chuck them in the fire, and start rewriting. Certainly, that's what we're doing. We were all well-trained, high-functioning corporate financiers and all that good stuff, but we're having to be super innovative at the moment and come up with new ways and new mechanisms and new methodologies to address today's environment. So if we're doing it, I would encourage that the audience just dismiss everything they think they know about M&A and start again. Be flexible. Listen to what the buyer wants. You know what I mean? A buyer's got a lot more stringent parameters within which to operate. And if you can fit into those parameters, you're going to win.
Awesome. Thanks, Dustin. I'd love to hear from the audience what your takeaway was from today's webinar and from this insight into selling your business during COVID-19. So please do put in the chat box for us, what was the one thing that you took away from today's conversation? Would love to see that feedback and get that feedback. And then Maurice, handing back over to you.
Brilliant. Thanks, guys.
You're gone back on mute, Maurice.
Yeah, sorry, I was just seeing if there's any further questions or comments. I think that's a wrap, eh?
Awesome. Well, thanks for having us, guys. That was a lot of fun.
Thanks so much. Super interesting. Thanks to the attendees, Dustin, Carl. Thanks a million. We have further webinars. I see there's another webinar tomorrow, a super interesting one. It's with Gillian Gork, who's going to guide us through high performance mentality. He's a mentalist. He's a friend of mine, and he is going to be super, super interesting. So please join us for that. If you require any information, if you want any of our pro bono services, please go to our website, www.cobra.org.za, or send us an email, info@cobra.org.za. Thanks, guys.
Perfect. Thanks. Cheers.